Key person insurance is essentially just a life insurance policy, and it's taken out on one of the shareholders or a key individual to the business, and it's used. The proceeds are used for the buyout of their equity portion in that business on an unexpected death. Yeah, so the difference between life insurance and key person insurance, essentially, it's still the same. It's a life insurance policy. However, with key person insurance, there's always a corporate interest involved. So there's a business entity that either has a shareholder or a key person to that organization that drives revenue and growth. So it's for protection for the business versus life insurance is protection for your family. So, as an organization, you should consider key person insurance in the unexpected death of a shareholder, and the proceeds are then used to buy out the deceased shareholder's estate. So, ultimately, when I talk with clients, more often than not, this coverage is not set up, and most likely because they haven't considered a scenario where one of the shareholders passes away. So, if we do that right now, let's just assume I own 50% of a $10 million business with my business partner. So in the event that my business partner passes away, usually there's two scenarios that occurs. And one is either I buy out his portion of the estate, or his estate continues to own that existing 50% portion. Now, most business owner clients of mine that I talk to, for good or for bad, don't want to be in business with their deceased business partner's spouse. For that reason, the majority of the time in this scenario, you would want to buy out that portion of the estate. The challenge there becomes, how do you do that? So really, there's three general ways that business can take that on. One of them is you have $5 million worth of cash. That's 50% of obviously 10 million. So if I have $5 million in the bank account, easy to do, buy that deceased shareholder's estate out. More times often than not, a business is not hanging on to that much cash relative to the value of their business and the side of their organization. So the second option is bank financing. Now, if I'm a shareholder, I don't want to be reliant on a bank who tend to be fairly conservative in lending nature for the longevity and viability of this buyout. So the third is a pure and simple transfer of risk to an insurance company, meaning I go and get a $5 million life insurance policy on myself. My business partner as well goes and gets a $5 million life insurance policy on them. It's all owned for by the corporation, paid for by the corporation, and the beneficiary is the corporation. So in the event of a death of either one of us, $5 million immediately tax-free comes into the business and then is immediately available to buy out that deceased shareholder's estate. We tend to want the lowest cost option available majority of the time, which is always term insurance. Term insurance is effectively rental insurance. You own it for a period of time that you feel you'll need that risk, and then you cancel it when you don't. So generally, 9 times out of 10, key person life insurance planning will be a term 10 insurance policy because that's the shortest amount of term and effectively the lowest cost available. There's also scenarios where businesses are doing very well from a cash flow perspective, and the shareholders are looking for tax efficient ways to grow wealth. And then in those scenarios, we can start to look at a whole life or universal life insurance policy, which offers a building an asset that's creditor proof and has tax deferral options, but also you're owning the home versus renting the condo, meaning when you're paying for these insurance premiums, at the end of it, you'll always have something, whether it's some cash value built up inside of the policy or some long-term death benefit for estate planning and business succession. Yeah, I mean, we always joke in the life insurance world, like the best time to purchase life insurance was, yesterday. The reason why we say that is premiums increase as your age increases. Obviously, the closer you are to life expectancy, the higher the premium is going to be. So there's kind of two rules of thumb there. Obviously, the earlier the better. All insurance conversations will come down to cash flow. So it's always a cash flow conversation. Can the business afford to transfer this risk and onto an insurance company, pay those premiums to transfer that risk? But just in general, like from a timing perspective, the value of the business needs to be large enough that in the event of an unexpected death, that it would be financially impacted, meaning you wouldn't have enough cash on hand or the bank potentially couldn't lend you that much. So that's when you start to consider, hey, we might want to transfer this risk onto an insurance company instead of taking this on ourselves.